By 1929, Germany, despite the burden of crushing reparations, appeared to be making significant progress toward economic recovery. More broadly, much of the Western world seemed to be stabilizing after the immense disruption caused by World War I. The end of the war required major economic and social adjustments, including the reintegration of millions of soldiers into civilian life, the conversion of factories from wartime to peacetime production, and the management of fluctuating markets and supply chains. Although these transitions were challenging, the years between 1925 and 1929 saw what appeared to be a period of growing prosperity, particularly in the United States. Industries such as automobiles, oil production, gasoline stations, auto repair services, radios, movies, and refrigerators expanded rapidly, many benefiting from growth that had begun during the war and continued into the consumer-driven peacetime economy. Beneath this apparent prosperity, however, serious structural weaknesses remained, especially in the agricultural sector. These hidden problems would ultimately contribute to the onset of the Great Depression, the most devastating economic collapse in modern history. One of the major causes of the Great Depression was the agricultural crisis that began during World War I. During the war, European agriculture suffered greatly as millions of farmers were drafted into military service and horses and oxen were taken from farms for use in transporting artillery and military supplies. As a result, women, children, and the elderly were left to maintain farms with limited labor and resources. To meet their food needs, countries such as Britain and France increasingly depended on imports from Canada and the United States, creating enormous demand for agricultural products and driving food prices to unusually high levels. American and Canadian farmers eagerly responded to these opportunities by expanding their farms, renting additional acreage, borrowing money to purchase modern machinery, and producing as much food as possible. These decisions seemed wise at the time because high prices encouraged greater production and promised substantial profits. Just as consumers tend to spend more when they have money to spare, farmers invest and expand when they expect strong financial returns from their crops. But the wartime boom could not last forever. When World War I ended, European farmers returned home, reclaimed their land, and resumed agricultural production using the best animals and equipment they had been able to preserve during the conflict. As European agriculture recovered, the need for imported food declined rapidly. By the early 1920s, agricultural production in many parts of Europe had nearly returned to pre-war levels, causing demand for grain from the United States and Canada to fall sharply. American and Canadian farmers, however, found themselves trapped by the very success they had enjoyed during the war. Having borrowed heavily to expand their farms, purchase land, and invest in new machinery, they could not simply reduce production when prices began to fall. Instead, they were forced to maintain high levels of output in order to generate enough income to repay their loans and meet their financial obligations, even as the market for their crops continued to shrink. The result was a cycle of overproduction and falling prices that devastated farmers across North America. As too much food flooded the market, crop prices dropped sharply, reducing farmers' incomes. In an effort to earn enough money to pay their debts and mortgages, many farmers responded by planting and harvesting even more crops. This only worsened the problem by increasing the surplus and driving prices down further. By the late 1920s, thousands of farmers were unable to meet their financial obligations and were forced into bankruptcy. Unlike today, farmers had little government assistance. There were no federal farm subsidies, no crop insurance programs, no price supports, and no emergency loans to help struggling agricultural families. As farmers lost their land and businesses, many rural banks that had loaned them money also collapsed. The crisis spread further when larger financial institutions that had invested in or loaned money to those rural banks suffered losses as well. Although this agricultural collapse steadily weakened the American financial system throughout the 1920s, few people recognized the danger because rising stock prices and apparent economic prosperity created the illusion that the economy was fundamentally healthy. During the 1920s, stock market speculation became fashionable among ordinary Americans. Before World War I, small investors put their money mostly into real estate, especially in Florida. But when massive hurricanes in the late 1920s devastated Florida land speculation, small investors turned to the stock market. Stock prices rose rapidly during the 1920s, But much of this growth was driven by speculation rather than by the actual value or profitability of companies. Investors increasingly bought stocks simply because they expected prices to continue rising, and the growing demand pushed share prices even higher. Many people entered the market hoping to make quick profits, often paying little attention to a company's earnings, assets, or long-term prospects. At the same time, countless investors purchased stocks with borrowed money through a practice known as buying on margin, which allowed them to pay only a fraction of the stock's price up front while borrowing the rest from brokers. This created a highly risky financial environment. There were few government regulations governing the stock market, no Securities and Exchange Commission to oversee trading, no meaningful margin requirements to limit speculation, and few protections against fraud or market manipulation. As a result, stock prices became increasingly detached from economic reality. Although many people believed prosperity would continue indefinitely, the stock market had become a speculative bubble that was vulnerable to collapse once investor confidence began to weaken. On October 24, 1929, later known as Black Thursday, the stock market's long period of speculation and rapid growth came to a sudden and dramatic end. Stock prices began falling sharply, triggering widespread panic among investors. As fear spread, millions of shares were put up for sale as investors rushed to unload their holdings before prices fell even further. The selling was so intense that the New York Stock Exchange lost an estimated $4 billion in value in a single day. The volume of trading was unprecedented, forcing exchange clerks to work until the early hours of the next morning just to process the enormous number of transactions. Although leading bankers briefly attempted to restore confidence and stabilize the market, the panic continued. By the following Monday, the crisis had deepened, and thousands of small investors, many of them ordinary middle-class Americans who had invested their savings or borrowed money to buy stock, found themselves financially ruined. By the end of 1929, stock values had fallen by approximately $15 billion, and the market had lost about 40% of its value during October alone. The damage extended far beyond individual investors. Those who had purchased stocks on margin were unable to repay their loans, and many banks that had financed these speculative investments suffered devastating losses as well. As bank failures increased, confidence in the financial system eroded, helping to transform a stock market crash into the broader economic catastrophe known as the Great Depression. When the various weaknesses of the 1920s economy are considered together, it becomes clear why the Great Depression became so severe. Farmers who had borrowed heavily during the wartime agricultural boom found themselves unable to repay their loans as crop prices collapsed. Rural banks that had lent money to those farmers suffered heavy losses and often could not repay the larger banks from which they had borrowed. At the same time, the stock market crash left countless investors unable to repay loans used to purchase stocks on margin, causing additional losses throughout the banking system. As loans went unpaid and investments lost value, banks struggled to recover their capital and remain solvent. Between 1929 and 1932, more than 5,000 American banks failed. Because there was no Federal Deposit Insurance Corporation, FDIC, to protect depositors, bank failures often meant that people's life savings simply vanished. For millions of Americans, a bank closure meant losing everything they had worked for. Families lost their savings, homes, and jobs. Businesses went bankrupt. Schools and local institutions closed, and entire communities suffered economic collapse. What had begun as a largely unnoticed agricultural recession during the 1920s ultimately spread through the financial system, intensified by the stock market crash, and grew into a global economic catastrophe known as the Great Depression.